Hey, joining us here at Post 9 is Mizuho Securities U.S. Chief Economist Stephen Ricchiuto. It's great to have you back, Stephen.
Well, thank you.
Good to see you. So Jason Furman has brought this up. Goolsbee brought it up this morning, said it would be perfectly appropriate after you got there. You think it happens?
Let me put it this way. If it happens, it's a disaster. So much of the Federal Reserve's credibility is tied to the 2% number. Once you start playing with the 2% number, you lose your credibility. And that is the biggest concern the Fed should be looking at. And the more they give this, oh, yeah, we're committed to 2, but wink, wink, maybe we're not, the more you're likely to see long-term rates go up because inflation expectations become unhinged. And this is their biggest problem.
But can't they change it? I mean, wasn't it in 2012 when Bernanke put it in play? Could you lower it, raise it, go back to stability as a target, get rid of the number altogether? Conditions change all the time. Why do they lose credibility if they say, hey, maybe we need to make a reassessment here?
Because the reality of the situation is if you start allowing inflation to be an adjustable variable in terms of the thought process of what people are thinking in terms of their business decisions, you unanchor expectations. And when you have a Federal Reserve which is more dominated by political economists these days than academic economists, you have a risk that we go back to the scenario that we had before Paul Volcker, which was where monetary policy was driven by fiscal policy. And the reality is we have a fiscal policy that's out of control. If the Federal Reserve attempts to continue to sustain or believe that employment is more important than inflation, then you get an environment where inflation expectations could easily become unhinged. Rising long-term interest rates become a problem of their own. And then you have to go back and reprove your credibility. And that could be even decidedly higher short-term rates. The Federal Reserve would be better to just stick with it, confirm it, go with it, and do what they need to do, get it out of the way quickly, get the shallow recession over and done with, and get it done with and move on.
Steve, I'll let you jump in and maybe ask if you can give us a read as to how this is getting read within the Fed and among staff.
I'm sorry to mix my metaphors here, Carl, but I don't hear the wink-wink that Steve is hearing. I read Austin Goolsbee today. I thought he made a very profound defense of the idea of sticking to the 2% target. Basically, if you want to live like a dove, you better walk or act or fly like a hawk, is what I heard Goolsbee saying. And as the idea being that if you need to stick to that target, he said that it was Federal Reserve credibility that has played a big and important role in bringing inflation down now without much pain. And if you want to avoid a recession, you better stick to that credibility. You better hold on to that 2% target. Maybe we can do it later, but I don't see that as a wink-wink for not doing it now. The only thing I would say, Steve, that you might be right is so far the Fed has been able to stick to the 2% target without much pain. And that pain has not come yet in the unemployment rate. The government is able to sell bonds, is able to service the debt. If that becomes more difficult, then there's a question about the 2% target. But we're not there yet, and I don't hear the wink-wink.
Well, I hate to disagree with you, Steve, completely, but the reality of the situation is you go back to the comments he made the other day. There was clearly a wink-wink involved there. And, yes, he comes back today with a different scenario because the bond market goes up. This is the problem with the things they say. They change their mind day to day, and they come out with different comments. They float different trial balloons. There's all sorts of academic discussions about flexible policies. But by the same token, they raise their growth numbers. They lower their unemployment rate numbers. They push out their target to get to 2%, and they still leave 50 basis points worth of rate cuts in their 2024 outlook. The numbers don't add, Steve. The numbers don't add, and this is the problem. The market's beginning to look at what they're saying and what they're doing and saying, none of this stuff makes sense. They're losing their credibility.